What do Ronald Reagan and most leftists have in common? Right? The argument is that we have not enough of a supply and to fix a certain problem, and we need more of that supply to address that problem. In this particular study, we look at housing prices. The common argument is we need more houses, we need more houses, we need more houses. The logic is housing prices are high, there must be a shortage, more houses will decrease prices. But in this research project, Chris McElroy and I asked, maybe something else is driving that? Will adding houses reverse that price? And do we even want it to? Famously, when house prices dropped in 2008, it was the worst thing that's happened to our economy in 100 years. This is the prices across the United States in the last 10 years. Precipitous rise in 2019 around COVID. This is units of housing per household in the United States. Increasing. More houses per household than we've had probably in about 50 years. So we're doing all right on supply. So no absolute supply problem. But we could have a relative supply problem. Maybe we have demand outstripping supply. But what do we do with demand problems? Well, if it's like chocolate, prices are too high, we don't have enough chocolate, we'll create more chocolate. But for things that are public health, like cigarettes, we don't want to create more. We deal with public policy solutions. So housing as a human right, we might address differently than just thinking about we need more of it. So in this study, we looked at 4,000 closing documents in Burlington over the last 20 years and found that investors tend to pay with a ton of cash. As investors increase in the market from about 1% 20 years ago to around 20% recently, prices tend to skyrocket. They've almost doubled in the last 20 years. And if incomes in a location are steady, we see that down payments rise. Right? So we modeled the interaction between investors and down payments since we see that that's really important. And we see that housing prices have increased by about 285,000 in the last 20 years in Burlington. A lot of that is just coming from controls like prior sale prices, but interest rates also driving the increase. Talk to me at the table if you're interested in why. But this is that big piece. A huge chunk of that increase is coming from investors in the marketplace. Not much with down payment, but a lot when investors and down payments are interacting in the marketplace. So come talk to me about that. And adding homes to the market actually increases home prices in Burlington. It's only when homes sit on the market and don't sell and create this glut that they can actually decrease prices, but only very little relative to what investors and down payments are doing. So just like in the 70s and 80s, we need to push back against this idea that the wealthy will provide for our needs. Tax breaks don't create jobs. Investors don't create affordable housing. And what we need to do is apply this logic to things that aren't just housing, things like education, healthcare, transportation, childcare. Because if we don't, we're going to be thinking about Reaganomics and a little bit of progressive clothing.